All right, today we're going to put on our detective hats. We're diving headfirst into what looks like the total chaos of the financial markets to see if we can uncover a hidden pattern, a secret order that explains why some days are super calm and other days are, well, just wild. And our main tool for this investigation? It's a pretty powerful model called Arch. So let's start with the scene of the crime.
So here it is. This is our central mystery. You're looking at a chart of Google's daily stock returns from 2016 to 2021. And yeah, it just looks like a complete jumble of random spikes and dips, right? Totally unpredictable. But what if I told you there's a structure hiding in all that chaos? A kind of rhythm that we can actually model and, well, understand?
Okay, so before we start dusting for fingerprints, we need to make sure we're looking at the right evidence. And in finance, that means we don't really focus on the stock price itself, but on its daily return. Let's dig into why that little distinction is so crucial.
Check this out. On the left, you've got the stock price. See that clear upward trend? In statistics, we call that a non-stationary series. And it's really hard to analyze because its fundamental properties, like its average, are always changing. But now look at the right. Those are the returns. It just kind of bounces around zero. It's stable or stationary. And that is a much better starting point for our investigation.
So here's the bottom line. Returns give us a stable baseline to work from. They're all about percentage changes, which makes it super easy to compare Google to, say, Apple or any other asset. And because they're stationary, they're just way easier to model. From here on out, our entire investigation is going to be focused on these returns.
All right, now that we're focused on the right data, let the real fun begin. It's time to start looking for our first major clue. We're going to stare right into the chaos of that returns chart and see if a pattern starts to emerge. At first glance, it still looks like chaos. I get it. But look a little closer. Do you see how there are these periods where the swings are really small and tight? Now, compare that to that big section in 2020, where the spikes suddenly get huge and just stay that way for a while. It's like the calm periods and the chaotic periods are all clumped together. You know this phenomenon we're seeing? It actually has a name, volatility clustering. And this is our first big break in the case. It tells us that market volatility isn't completely random after all. What happened yesterday? It gives us a real clue about what might happen today.
The best way to think about it is like financial weather. Trying to predict the exact return for tomorrow, that's almost impossible, just like predicting the exact temperature. But if there's a hurricane today, you're probably not going to plan a picnic for tomorrow, right? Stormy days tend to follow stormy days. And now for our second clue. If we plot out the distribution of all these returns, we find something else that's a little weird. On the left, you can see the histogram is much more peaked in the middle than that nice smooth bell curve. And on the right, see how the dots stray way off the red line at both ends? That's a huge sign that our data is not normal.
Those deviations at the end have a name too. They're called heavy tails. And what they are is basically the statistical footprint of extreme events. It means that massive market swings, both crashes and surges, happen way more often in the real world than a simple bell curve would ever lead you to believe. Any model we build has to be able to account for this. So let's recap our clues. We've got volatility clustering and we've got heavy tails. The market is behaving like a complex, stormy weather system. So now we need the right forecasting tool to actually model it. It is time to introduce our detective's secret weapon, the Arch model.
I know, autoregressive conditional heteroscedasticity. It is a total mouthful, right? But let's just break it down. Autoregressive just means it uses past values. Conditional means today's volatility depends on yesterday's conditions. And heteroscedasticity, that's just a really fancy word for changing variance or volatility. So in short, it's a model that was built for the exact clues we just found. So how does it actually work? Well, you can forget all the complicated math, because the logic behind the simplest ARCH model is actually super intuitive. First, it starts with a baseline, a long-term average level of volatility. Then it looks at how big yesterday's market shock was. Finally, it predicts that today's volatility is going to be some combination of that long-term average and the impact from yesterday's shock. So if yesterday was a huge shock, it pushes today's expected volatility up. It's as simple as that. And now, for the moment of truth, the climax of our investigation, we have a suspect, this Arch process, that claims it can explain the patterns we're seeing. It's time to see the definitive proof, the smoking gun that's going to confirm our entire theory. So first, let's look at some data that we know was generated by an Arch model. This is a simulation. And what do you see?
It looks just like the real Google data, doesn't it? It appears to be completely random, full of these unpredictable bursts. The pattern is still totally hidden.
So this leads us to the essential question, right? If the returns themselves are just jumping around randomly with no predictable direction, then where on earth is the pattern that we've been hunting for this whole time?
Here's the first part of the answer. These charts are called correlograms. You can think of them as a kind of pattern detector. If there's a predictable pattern in the data, those blue bars will stick way out of the shaded area. And for the returns themselves, as you can see, everything's pretty much contained. This confirms they're uncorrelated and unpredictable, just like random static on a TV.
But here's the reveal. This is the moment it all clicks into place. We are now looking at the exact same charts, but for the squared returns. Now, squaring the returns is just a clever way to measure their size or their volatility, regardless of whether they were positive or negative. And bam, look at that. The bars jump way outside the shaded area. We see a clear, predictable, decaying pattern. This is it. This is the hidden structure we've been looking for. So what does this all mean? The crucial takeaway is this. The returns themselves are memoryless. They're random, but their volatility is not. Volatility has a memory. A large shock yesterday makes a large shock today much more likely. This is the secret that was hiding in plain sight, and the Arch model is what finally allowed us to see it. Okay, so we've cracked the case. We've found the hidden pattern. Awesome. But why does solving the statistical mystery actually matter? Well, it turns out that understanding this pattern has huge implications for pretty much the entire financial world. Well, being able to forecast volatility is a really big deal. For risk managers, it's like having an early storm warning system. It tells them when to brace for impact. For portfolio managers, it tells them when to be defensive and when to be aggressive. It's also a fundamental ingredient for pricing things like options and other derivatives. And it even helps regulators figure out how much capital banks need to hold to keep the whole system stable. And the amazing thing is, the simple Arch model we've looked at today, the one that just looks back one day, that's really just scratching the surface. There are much more advanced versions that can look back many periods, leading to even more sophisticated and accurate models of that financial weather that are being used every single day. So, we'll leave you with this thought. We just found a clear, undeniable pattern of dependency in something that, on the surface, looked completely random. If today's volatility depends so clearly on yesterday's, you have to wonder, what other hidden patterns might be shaping the financial world that we think we know?